Do you know that if you're making $70,000 in Canada, you're paying anywhere from $16,000 to $17,000 in taxes every year?
What?
Yes, that's almost a quarter of your income. I know taxes can seem boring and intimidating at times. I was in that space a few years ago. I didn't want to stress my head on tax matters because I just felt it was boring. But I have come to understand that as immigrants or a citizen of any country, it is so important to be knowledgeable about the tax system in the country that you're in. It will help you know the benefits out there that you can utilize so that you're able to keep more of your money in your pockets, especially after a tough year of stubborn inflation and the highest interest rates that we've seen in 2 decades. It is very crucial that we know what the important tax changes are so that we can plan to be in control of our finances as much as possible. In today's video, I'll be covering some new tax changes released by the government of Canada, and then we're going to get into the new contribution limits for TFSA, the tax-free savings account, RRSP, and the recently released FHSA. We're going to also look into CPP and the new pension enhancement, as well as the changes in the tax brackets. Some of these terms might be new to you if you're a new immigrant here. So I'm going to try as much as possible to break them down for you, just to make it easier for you to understand. So please watch to the end because this video is packed with helpful information. I will just give you some knowledge on this field. Before we get into the details of today's video, I just wanted to let you guys know that I am not sharing this information under any financial capacity or qualification or authority, all right? I am not an accountant. I don't deal with taxes. This information is mainly from my personal research and they are available to everyone, I believe. I'll also do my best to list my sources in the description box of this video. If you live in cities with housing shortages like Vancouver, Toronto, and Montreal, and you have short-term rentals like Airbnb like we do here, there are major restrictions to short-term rentals that kick-started this year. The federal government intends to deny income tax deductions for expenses incurred to earn short-term rental income, including interest expenses in provinces where short-term rental restrictions are in place. And these measures will apply to deny all expenses incurred on or after January 1st of 2024. Do you know that there are almost 19,000 homes being operated as short-term rentals that could have been used for permanent housing in cities like Montreal, Toronto, and Vancouver? Due to this, the government aims to use this new legislation to put back thousands of units back into the long-term rental market. The Canadian government means serious business when cracking down short-term rentals with the aim to elevate the housing crisis here in Canada. Specifically in BC, starting in May of 2024, there are going to be restrictions where you would only be limited to short-term rentals pertaining to principal residence and a secondary dwelling. So if you own multiple properties for the purpose of short-term rentals like Airbnb, this will no longer be allowed and will become illegal to operate in BC. If you're planning to do short-term rental with your principal residence, you'll be required to register with the province. If this is applicable to you, make sure to check out the rules in your area about the short-term rental restriction. These restrictions might extend to other provinces in subsequent years. No one knows. But we are taking the possibility into consideration when it comes to our short lease rental property in Alberta. The next update is relevant to those who see physiotherapists and counseling therapists. You can expect to see a reduction in your bill if you are amongst those people. As the federal government announced that it will be taking GSD and HSD of these professional services to help ensure Canadians could afford the care that they need. According to the parliamentary budget officer, the measure will cost about $65 million in loss of revenue over the period of 5 years. Now that we've got those two updates out of the way, let's get into the new contribution limits. First is the tax-free savings account, TFSA. Tax-free savings account is a tax-sheltered investing account that was first released in Canada in 2009. It is flexible and can be used towards any savings goal that you have. In a TFSA, you can invest money and earn income in interest, dividends, and capital gains tax-free. Typically, if you invest in a taxable account, right, you are subject to tax on your earnings every year. So the compounding tax savings on your investments in your TFSA can be significant over time. Guys, this builds up over time if you're serious about savings. And you can put as little amount as you can, keep them growing there. You don't have to wait till you have a huge amount of money or a huge pay before you start saving. Even as a new immigrant, you can start with that pay that you think is not enough. You can just put something little aside for saving. Every little savings counts, guys. It took me a while to realize that, but it does count. The great thing about TFSAs is that you can withdraw from it at any time without any penalties. The only catch there is that withdrawals made will be added back to your TFSA room the following year. How much you can contribute to your TFSA is determined by your contribution room, which goes every year by the TFSA annual room limit. Make sure that you know your limits because any over contribution are subject to hefty penalties. As you can see here, the 2024 TFSA annual room is indexed to inflation and increased by $500 from $6,500 last year to $7,000 Canadian dollars this year. Your TFSA contribution limit accumulates over time and any unused room is carried forward. So it doesn't just disappear, right? It's carried forward to the next year. I will elaborate on TFSAs and how it works in my future videos, so stay tuned. Now, let's talk about the Registered Retirement Savings Plan. The RRSP is a registered account with the Canadian government with the purpose to save towards your retirement. In RRSP, you invest your money and you earn interest, dividends, and capital gains on a tax-deferred basis. This means that income does grow in your RRSP tax-free, but you are eventually taxed on the income when you withdraw from your RRSP, right? Ideally, this should be when you retire. Typically, if you invest in a taxable account, which is a normal bank savings, right, you are subject to tax on your earnings every single year. But in your RRSP, your investment income doesn't get taxed. You can grow it over time tax-free. But of course, it will be taxed when you eventually withdraw it in the future. The greatest advantage, I believe, with an RRSP is that the contribution that you make are tax deductible. In simple terms, it means that when you contribute to your RRSP account, it reduces your taxes and potentially puts you in a refund position. However, since you receive the benefit of a tax deduction because of the contributions that you made, when you want to withdraw from your RRSP, there will be withdrawal tax charged. You also need to include withdrawal amount in your income and be taxed on it. It's important to note that you can only contribute to your RRSP based on your RRSP deduction limit, all right, which should be on your notice of assessment from the prior year. Any over contributions are subject to penalties and can be quite a pain to undo. So make sure that to always check your RRSP limit before contributing. The RRSP deduction limit is generally the lower of either 80% of your earned income from the prior year, or 2, the RRSP dollar limit. In 2024, the RRSP dollar limit is $31,560, which is indexed for inflation every year. If you don't contribute to your RRSP or you haven't maxed out your RRSP room, your RRSP limit does get carried over to the next year and accumulates so that you can contribute anytime in the future. The next one is the first Home Savings Account, FHSA. The federal government released a new type of savings plan last year in 2023, which aims to help Canadians save for their first home. I really wish I had that opportunity before I bought my home. But yeah, the most exciting feature about this FHSA is that it combines the best part of the TFSA in which you can tax deduction for your contributions, which is a win-win on both sides. Note, you can only withdraw from your FHSA tax-free if it is used towards a qualifying home purchase. The contribution limit for FHSA is maxed out at $40,000 over your lifetime and up to $8,000 in any given year. This means that you can max out your FHSA by contributing 8,000 Canadian dollars per year over, let's say, over the 5-year period to reach the $40,000 limit. Once you open your FHSA, you can also carry over the unused contribution that you haven't used for the year to a later year. For example, if you opened your FHSA in 2023 but didn't contribute the $8,000 limit, you can carry over that amount to your 2024 and contribute to the total of $16,000. The main difference between the FHSA and the home buyers plan that we already had, which is under the RRSP, is that the withdrawal is $40,000 versus the other one, which is $35,000. This means that you can withdraw $5,000 more tax-free under the FHSA. In addition, you are not required to pay back the $40,000 under the FHSA, whereas under the home buyers plan, the HPP, you need to pay back the withdrawn funds within a 15-year period. Otherwise, that amount gets included in your income. Also, if you have enough savings, you can also take advantage of both the FHSA and the HPP so that you can make a combined original contribution of about $75,000 tax-free towards your first home. The next important update we need to talk about are tax brackets. We're going to go over the tax brackets and any important changes that has been implemented, the tax rates this year. As a Canadian resident, you will be subject to two separate tax rates, the federal and the provincial territorial tax rate. You can see here that the federal rate on the first $55,867 of taxable income is 15%. Let's use BC for example, and the BC provincial rate on the first $47,937 is 5%. This can feel confusing for two reasons. First, the taxable income brackets are different for federal and provincial. Second, you're working with two rates, the federal and the provincial rate, which you would need to combine to get your applicable rate. What you can do is use the combined federal and provincial rate to get better idea of the tax rate that would impact you. In this table, you can see that the first $47,937 of taxable income is subject to a combined tax rate of 20%. Another thing you need to understand is that we have a progressive tax system, meaning that your income is taxed incrementally based on the tax brackets that you fall under. So if you earn $70,000, you get taxed at 20% on your first $47,937 and 22.7% on income between $47,937 up to $55,867, and then 28.2% on income over $55,837 up to $95,875. It does not mean that if you earn $70,000, only the last applicable rate of $28.2 applies to the entire income. I hope that makes sense. Now, going over the tax rates in general, there is good news with tax brackets being more favorable to Canadians this year. You can see that the tax rates itself haven't changed, but the tax brackets have increased. This means that a higher income is taxed at lower rates. You can notice this in the highest tax bracket, in which the highest taxable income in 2023 was $240,716. And now in 2024 is $252,752. This means that $12,036 is getting taxed at lower rates of 49.8% instead of 53.5%. Now let's talk about CPP. Canada Pension Plan is a pension available to Canadians when they retire and that pays out a monthly taxable benefit. You can start receiving CPP when you are at least 60 years old until the rest of your life. For 2024, maximum amount that you can receive if you start your pension at age 65 is $1,364.60. However, the average monthly amount paid for a new retirement pension plan at 65 in October of 2023 was about $758.32. Your situation will determine how much you will receive up to the maximum. To receive this benefit when you retire, every person over the age of 18 who works in Canada and earns a minimum of $3,500 per year must contribute to the CPP. The amount you contribute depends on your employment income. You may have noticed CPP as one of your deductions from your paycheck. And while it may feel like another tax, I really don't like it. But technically, it is money that you will see back when you retire. In fact, your employer also contributes towards your CPP as well. In 2024, the CPP contribution rate stays the same as 5.9% of your earnings, the same rate as 2023. However, the 5.9% applies to new maximum annual pensionable earnings of $68,500 up to $66,600 in 2023. As an employee, this means that if you earn more than the maximum annual pensionable earnings, you're capped at max CPP contribution of $3,867.50 as an employee, up from $3,754.45 last year, and your employer will also have to match up that amount. If you're self-employed, you need to pay both contributions as an employee and as an employer, up to a maximum of $7,735. But that's not all the changes to CPP in 2024. There is now a second additional CPP contribution that began January 1st of 2024 for workers who earn higher wages. It's important to understand the first earnings ceiling, which is $68,500, as mentioned previously, and the new second earnings ceiling, which is $73,200 for 2024. So this means that you need to take the difference of the two and apply a contribution rate of 4% to it. So the maximum that you would need to pay if you earn about $73,200 or more, it's a maximum additional CPP contribution of $118 extra, which also needs to be matched by your employer as well. If you want more details on the various plans that we went over today, please let me know in the comment section and we will go into it more details in our future videos. And also, if you found this video helpful, please support the channel by hitting on the like button right there. Subscribe to the channel and turn on notification bell so that you get notified whenever we upload a new video. And I just also wanted to say welcome to our newbies here, and thanks to our OGs that are always watching our videos. So if you're new here, welcome. My name is Zini. Here we make videos on our life in Canada. I and my husband, and we share information that will help immigrants navigate, settle, and succeed in Canada. So it's just good vibes here. Don't forget to subscribe, okay? And yeah, it was wonderful talking to you guys again on today's video. Thank you so much for watching. So go check out this video, and I know you'll enjoy it. See you all in my next video. Bye.